Good morning, everybody. Welcome to PSG of Mercer County, and happy Aloha Friday. And for those of you visiting us for the first time, yes, indeed, I am wearing my Hawaiian shirt, my Aloha shirt. It's just my thing on a Friday. Some of you, or all of you, are welcome to do so. Some of you do wear your Hawaiian shirts during the meeting, so it's nice to see. And so I want to welcome everyone to the Professional Service Group of Mercer County. There are several PSG groups in the state. We'll talk more about that later. So this is the one kind of based in central New Jersey in the Princeton area. But now, of course, we are virtual. I'm glad you can join us. PSG of Mercer County is a group that is here for you, anybody that is in any kind of career transition. It doesn't matter why you're in a career transition. A lot of people are affected when their own former employer makes a financial decision. That happened to me twice in my career. Other times you take your career in your own hands and you're going to go in another direction. Or for some people, you're returning to the workforce after taking a personal or family time that was important to you. We're here to provide any information, resources, a little bit of guidance, these weekly meetings, all to help make you become more efficient and effective in your own job search. And one thing that's kind of fun with our group, we also like to celebrate when we can. So I'd like to also say to you, Happy National Cheeseburger Day. So today is National Cheeseburger Day, and it's still going to be nice weather. So maybe you'll go out and barbecue or go to a restaurant that has outdoor dining, whatever the rules are in your neighborhood and community. And it might be a day to have a cheeseburger. Even the fast food restaurants have cheeseburgers. Among the resources that we provide all of our members and even just visitors, we do have a LinkedIn group. Our LinkedIn group is called PSG of Mercer County. It is a group really for anybody that is in job search. Now, the one limitation is that we only admit people or to become members of our LinkedIn group if you've been to our group here at least once. Either you've been when we were in person, you came to the library, or virtual, and that's fine too. So with our LinkedIn group, we have over 1,600 members. These are all people that are either former job seekers, current job seekers in some cases, and some of our meeting presenters as well. So all people that kind of share the mission and are concerned about job seekers. We do invite you to share articles, share posts, comment, participate in some of the discussions, because the activity in our group will help your profile in LinkedIn as well. And we seem to have a very active group of members that do contribute. And it can even be something as simple as you got that email the other day of a wonderful position, and it's just not the right position for you. We've all gotten emails like that. Copy it out of the email, paste it into the LinkedIn group, and share it with others. It'll help your profile, and you'll be helping others as well. If you are not yet a member, please go to our LinkedIn, find the group, and click the join button. You will be put in pending status, and then what I do is I will check our attendance records to see if you've been here before. If you and I don't know each other, one thing I will ask, if you don't mind, send me an email at psgofmercercounty@gmail.com, psgofmercercounty@gmail. And you can simply say, you know, David, I was at the group with Bill and like to be able to join the LinkedIn group. We also have our website. It is psgofmercercounty.org, psgofmercercounty.org. It is over 120 pages of website content. So it is more than a landing page and a calendar. It's a lot of information that we've put together in order to help anyone in job search. And so you may find it helpful for yourself as well, and you are certainly welcome to use it. We have a whole section on what we call career options. It's a menu item. And if you're new to job search, we've got in that menu item a section that talks about getting started in the job search. Or maybe you've been searching for a while, you want to learn about ways of switching from full-time to consulting. Maybe you're interested in starting a business or even just volunteering. So we discuss all those in our website. It's not the be-all, end-all of any of those topics, but it may be a good place to get started or one place to get started on a number of topics. So it may be a nice centralized location. I did mention earlier that we like to celebrate, of course, hence the Hawaiian shirt. But also, if you have any good news, something recent, maybe like a landing, or you're that close, if you want, share it with us in chat. Chat is in the upper right corner of your GoToMeeting screen. It looks like one of those little cartoon call-out buttons, a little circle with a tab coming off the end of it. And in there, you can write a chat or a message. A good idea, write it to everybody. You can send a chat to any one person, like as a text, but share it with everybody. And if I pick up on it a little later, I will congratulate you in the group as well. Just want to remind you that we have a couple of ground rules, and the ground rules are going to be, please keep your microphone on mute. Bill will share his screen in just a moment, so we will all be able to watch that. So he will be the presenter for the meeting and show his slideshow. Bill, you're the only one who does not have to be on mute, of course. But again, to keep just the possibility of background noise from interrupting the program. As for your video and your camera, that's your call. You could decide to keep it on or keep it off. Keeping it on is a friendly way to kind of maintain the networking and the connection, but no worries if that's not what you want to do right now or today. Maybe you could do it later in the open networking. And there's also a button at the top of your screen. It may say right now, view everyone. That's if you have the GoToMeeting screen. It's a menu item. You can actually change that if you'd like to other options. Maybe just view who's talking. So you'll see the box of just Bill, and then you'll see his presentation. Or maybe active cameras, which means the people that don't have their cameras on right now, they'll be hidden. You won't see the gray boxes. You'll just see the faces who have their cameras on. So that's your choice. Okay, and for questions, we're going to entertain questions in the chat. We'll use chat for questions. So if you have a question for Bill on any of his slides, just put it in the chat. And what I will ask is that you do precede your question with the word question. We already have a lot of chat activity in there, and you're welcome to use it for other needs like communicating with others or providing your contact information, your elevator pitch. But it make it easier for me to spot your question. And so I will see the word question, and then if it's about the Affordable Care Act or anything else, Bill or I will pick that up. So we'll make sure, hopefully, not to miss your question. And if I remember, Bill, we'll be accepting or taking mini breaks almost every slide. You want the questions to be as current as possible.
Yeah, that would be great. Yeah, I mean, I find that the presentation flows better if we're kind of asking questions going along.
Good. Yeah, so don't shout out the question, please. We're a big group. We're over 70. We're about 74, 75 right now. But right in the chat, I'll keep an eye, and then every slide or so, I may just let Bill know if we have a question, and we'll read it and take it. Or if not, we'll just move on to the next slide.
And the other thought I had, David, too, is if somebody has got the camera, if they just at least raise their hand, maybe we can let them unmute and ask the question that way too.
Okay, yep, if we spot that, you're welcome to as well. Maybe a little harder with the presentation up, but we will do our best to do that.
Oh, that's right, it'll be on the screen. Yeah, you're right.
Right, because the presentation will take up most of the screen.
Got it.
So
yeah, we'll probably use the chat to be better. Yeah, the chat would be better. Yep.
So yeah, so we want to try and make this, even though it's a virtual presentation, as interactive as we could practically make it. So terrific. And so it's just our pleasure, PSG of Mercer County's pleasure, to always welcome Bill LaChance. Bill is an independent financial advisor. His firm offers a unique flat fee program that combines financial planning, investment management, tax planning, and tax preparation. Prior to launching his financial planning practice, Bill spent 22 years in corporate finance in the retail industry, and before that was a CPA with a large accounting firm. Bill has his BS in accounting from Bryant University and an MBA in finance from Indiana University. Bill is a certified financial planner as well as an enrolled agent authorized to represent taxpayers before the IRS. So PSG of Mercer County is always pleased to welcome a terrific job seeker, advocate, and supporter, Bill LaChance.
Good morning, everyone. Let me just share my screen, the presentation. Yeah, I'll just give you a real quick addition, a little bit on my background. Yeah, as David mentioned, right, I had been working in corporate finance. I was in there for 22 years in the retail industry. I was working for Target and then Best Buy. But I knew that I wanted to have a second career. So in 2009, when the economy was tanking, I said I better have my plan B ready to go. And so I took the course to be a certified financial planner while I was still working for Best Buy. And then, as probably was the case with many of you, my job in 2013 was eliminated, and I had a decision to make. Do I want to go for one more corporate job? I was around age 50 at the time, a little bit early, or do I want to start this business? And I kind of rolled the dice and started this business. I was in job transition at the time. I was still thinking about maybe taking another corporate job. So I found out just by searching online about the Breakfast Club that somebody mentioned earlier. Went to that meeting, met somebody there that talked about a group in Short Hills called Careers in Transition. Went to there, and I met David Schuckman there, who told me about this group, and so that sort of became my niche. I started really working with people in career transition. It's essentially how I built up the business, and that I started this back in 2014. So anyway, so that's a little bit about me. As far as the presentation, it was not necessarily designed to be everything you'd ever want to know about. Let me just go forward here a little bit. Everything that you'd ever want to know about career transition. That was not necessarily the intent, but I wanted to try to hit some of the key points where maybe not everybody knows all the different nuances. And these are sort of things that I've kind of picked up working again with folks in transition over the years. So please ask questions on the chat as we're going along, and we'll go over there. So I'm going to start out with medical, right? I know that's a big issue for many people in job transition. And if you see the screen here, what you're looking at here is basically the income thresholds for the Affordable Care Act. So essentially, when you lose your job, right, and you lose your group insurance, you basically have got two options, right? Unless you've got obviously a spouse or a significant other with that health insurance, you're basically either looking at Cobra or you're looking at having to go on to the individual exchange. And you do have the opportunity during a 60-day window, right, to go either way, right? You don't have to necessarily go on Cobra. You could opt for the exchange if that's a better option for you. And the big difference, obviously, with the exchange versus Cobra is that the exchange, depending on your income, could potentially be subsidized, and you could have dramatic savings. And my sense is what I find a lot of people is automatically go to Cobra. Cobra could be quite expensive, as many of you know. Essentially, for those who are not familiar with Cobra, right? Cobra is a continuation of your existing group coverage. It's basically the same plan that you had while you were working, except now the employer typically is not going to be paying anything towards it. You're going to pay 100% of the bill, and I think they could even add on another 1 or 2% for administration fees. And then you have to allow it for at least 18 months, although they could extend it if they want. When I left Best Buy, my Cobra got offered for 5 years. So it doesn't have to be 18 months, but it has to be a minimum of 18 months. And so it could be quite expensive because you're paying for the full amount. Now, if you get an unsubsidized plan on the exchange, that could also be quite expensive. But you're going to want to at least look to see, whether or not it's a better deal for you. And it's at least consider it, right? New Jersey has been using the healthcare.gov, the federal exchange, since it started back in 2013 when it first started. But now this 2021, they're going to be switching to their own state-based exchange. Plans are the same, companies and all that's the same. It's just that the mechanics of how you would sign up would be different. So for those who are not familiar with the Affordable Care Act, essentially, as I mentioned, it's income-based, right? And it's based on the income in the current year. So basically what happens is you basically are estimating your income. And if your income falls below a certain threshold, so let's use on this chart that I've got up, let's use the family of 4, right? So if your income for 2020 was below $103,000 for a family of 4, you would qualify for a subsidy. And that subsidy could be pretty significant. So for example, back when I started out my first 2 or 3 years working or with this business, I was on the Affordable Care Act. Then eventually my wife got a job with insurance and we switched off it. But in the beginning, again, for 3 years, I was on it. And, because I was starting a business out from scratch, and my wife was just working part-time, our income was pretty low. And so, we qualified for a significant subsidy. So, it might have been, and I don't remember exact numbers, but it might have been, say, $1,300, a month premium for a family of 4. But after the subsidy, it ended up being like $275, right? And so, I mean, it could be pretty dramatic. And even if you get just under the threshold, the subsidy drops quite a bit. Because the way it works is the subsidies on the exchange are age-based, meaning they go up every year depending on your age. Most group plans are not. Most group plans are everybody pays the same. Whether you're a 25-year-old employee or a 63-year-old employee, you pay the same. The reality is, the older you get, the more likely you're used to use health insurance. So what's happening in most group plans is that the younger participants are subsidizing the older participants. So whether or not Cobra is going to be better than the exchange sort of depends on what age you are, right? For younger people, it's going to be typically cheaper to be on the exchange because, again, they're paying the price or the premiums for somebody that's at a young age. If you're in your 50s or 60s, you're unsubsidized, you're likely going to be higher than Cobra again because of the fact that you're pooled again based on your age, and it's going to be a higher premium. If you get a subsidy, however, what they do is they decide that the amount you could afford based on your income doesn't matter your age. So the age essentially gets thrown out the window if you qualify for a subsidy. So for example, let's say somebody 25 years old wants to sign up for insurance, and their regular premium might be $500 a month. Okay, and then based on the formula, right, the government decides based on their income they could afford $300 a month, so they get a $200 subsidy. The same person who's, say, 62, they might have an $800 a month premium, right, or $900 a month premium. Okay, but the government says you can pay $300, so they get a $600 subsidy. So the subsidies are much bigger for folks that are older, essentially, because the premiums are higher, and they're bringing the premium down to the income that the government has determined, right, that you could afford. And it's a cliff. The people that get really hurt by the Affordable Care Act are the people who are just outside of these thresholds. So a family of 4 making $106,000 is going to get 0 subsidy and have to pay the full amount. And so the income that matters for this is adjusted gross income. So if you look on your tax return, I don't have one in front of me, but you look on your tax return on the current, the way it's set up for at least 2019, adjusted gross income is line 8B. And so that's actually your income before, it's all your income sources, right? Dividends, interest, wages, unemployment compensation, capital gains, all of that, less any adjustments. Things like traditional IRA contributions, HSA contributions. You also get a deduction if you're self-employed for your health insurance. That's all above the line, they call it. Above the line, it brings you to adjusted gross income. What it doesn't include, that does not matter, is your itemized deductions or your standard deductions. That has no impact on this number, so it's before that, basically. And so what these subsidies are really, or the premium subsidies, what they really are tax credits that you're given in advance. So you're going to estimate your income, right? If you fall below these thresholds, right, that I'm looking at in blue, you're going to qualify for a subsidy. Okay, so let's say your premium is $1,000 and they determine that you should be paying $400, so there's a $600 subsidy. What happens is you pay the insurance company $400, the government pays them $600, right? And then that $600 is essentially a tax credit. Then the end of the year comes, and now you do your tax return, and you actually true up your income. What is your actual adjusted gross income? And if you estimate it high, right, and you come in lower, you're going to get an additional amount back when you file your taxes in the form of either a higher refund or a less of an amount that you owe, right? And on the other hand, if you estimate low, okay, you're going to have to pay it back at tax time. And obviously, the thing you want to certainly be careful of is coming in just over the threshold if you assumed you were going to be under the threshold, because now you have to pay back the entire subsidy. So maybe I'll stop there. Does that make sense to folks? Any questions on any of that so far?
Yeah, so one question from Penny is this nationwide?
This is nationwide. Yeah, the only states that have different thresholds are Alaska and Hawaii because of the cost of living. But other than that, these thresholds that we're looking at are same across the country. Now, the way you actually sign up for the plan varies by state. So, for example, I mentioned so the intent when the Affordable Care Act was written back in 2009 was that states would create their own exchanges, right? And then basically exchange is simply a marketplace. It's just a website basically where all of the companies that want to sell plans, right, to individuals in the state, they get their plans approved by the state regulators, and then they're all there. So it's like a shopping thing. You can just you have visibility to all the plans that are available to you. Okay, and the intent was that states would create their own exchanges. Well, there was a lot of resistance, obviously, on the Republican side to the Affordable Care Act. So what happened was, if the state opted not to create their own exchange, then the federal government had its own exchange, and the state pays the federal government money to manage it, basically, and then you use healthcare.gov, right? So, for example, New York has had their own exchange from the very beginning, California, Connecticut, whereas New Jersey at the time, Chris Christie was a governor, Republican, opted not to get the exchange, and so they've been using healthcare.gov, although now that Phil Murphy is the governor, they've gone ahead and created their own exchange because it saves them money ultimately, because they have to pay the federal government to use their exchange, essentially. But as far as these subsidies are the same everywhere in terms of the math, in terms of it. Now, the plans are different by state. The plans available to you in New Jersey are not the same plans that are going to be available to you in New York or Connecticut or Pennsylvania or any place else.
And another question from Mike: are you licensed only in New Jersey for medical insurance?
That I am, yeah. So as far as helping people, yeah, so I can help you. Somebody has a question, who can help? I can actually, so basically, I'm a financial planner, but because I was helping people, in job transition, and this became a big issue early on, maybe a year in, I got my health insurance license and started signing people up. I get a small commission basically when I get somebody to sign up, and the commission's the same no matter which plan you sign up for. And so that's, so if somebody does need help sorting through this, you can certainly reach out to me. And it won't cost you anything, right? Again, whatever plan you pick, if you do decide to pick it. If Cobra is a better option, then I'm going to tell you take Cobra, right? This is kind of a small little thing for me, but that's somebody there. But I'm only licensed in New Jersey. If you're outside of New Jersey, you can certainly call me, and I will, help you as best I can. But I can't get you signed up because I'm only licensed for health insurance in New Jersey.
Lee has a question. Can you please clarify what gets considered towards adjusted gross income?
Okay, so again, it's all your wages, everything on line one, right? So all your W-2 wages. It's going to be all your interest and dividends, right? Your capital gains, unemployment insurance is in there, Social Security benefits if you collect Social Security, and then those are the additions. The subtractions are going to be HSA contributions, IRA contributions, and it really would be on the top part of Schedule 1, basically anything on the top part of Schedule 1, or sorry, the bottom part of Schedule 1 rather. And then the only other thing that's typically people are going to have would be if you're self-employed. If you're self-employed, you got a lot of room to maneuver these numbers, right? Because you can set up a solo 401k. You could put your, if you're over 50, you could put, up to $26,000 into a solo 401k and bring your income down. So if you're doing consulting work or something like that and getting paid as a 1099, there's a lot of things you could do to manage that income down and potentially get under these numbers. And the thing to keep in mind is that these are income only. Assets have nothing to do with it. I literally have a few very wealthy clients, right, with millions of dollars of assets who are actually getting subsidized health insurance. It was certainly never the intent, right, to subsidize millionaires, but the reality is they are not drawing out of their IRAs. They don't collect Social Security. All they have is basically dividends and interest, and they're able to keep their income under those thresholds with just dividends and interest, basically, because that's their only income. Otherwise, you're just pulling out a savings account. So you can potentially be quite wealthy and qualify for these subsidies, but you got to be able to keep your income down.
Okay.
Other options I see That's it. Those are really your two options. I mean, there are some things like faith-based plans out there that I'm not super familiar with. They're not really insurance. They're not recognized by the government as being qualified insurance. I think it's something like where people all just sort of chip in and vow to help each other, kind of a thing. I personally would be very skeptical, and I'm sure there would be some kind of underwriting you'd have to go through. But as far as getting legitimate health insurance, your really only options are going to be Cobra and or the exchange. I noticed that all the plans. Yeah,
and
so
I think Medicare also for people over 65.
And then once you get to 65, then you're going to Medicare, and obviously that's one of the proposals, right? Biden has is that to lower the Medicare threshold to age 50. So we'll see if that all happens. But they did have kids in college, so I have mine. Back, my son is at Northeastern up in Boston, and we had him, and we were on the exchange. Horizon, which is one of the three companies that offers plans in New Jersey, does have an away from home care program where basically it's a cross selling agreement with the Blue Cross, the different Blue Cross organizations across the country. So just so you know, those are separate companies, right? Blue Cross of Massachusetts and Horizon Blue Cross of New Jersey are not the same company at all. They're totally independent. There's just sort of a marketing umbrella that they all kind of contribute to, but they have worked out a deal, for example, and Horizon has with many states, not every state, but many states. I know that I had a client who had a student upstate New York that was covered. My son in Boston was covered. And so, yes, you were able to, I was able to get him a plan up in Boston. It was really no problem. And he really had two cards, right? If he was back in New Jersey, he would use his New Jersey card. He was issued a Massachusetts card, and then he just used that card if he had to see the doctor in Boston. Contact the presenter. So I think David said there's going to be this deck will be available, and I'm going to leave the last slide up, which has my contact information for a little at the end, and you can just write it down, or just type in Bill LaChance into Google. I'm going to be easy to find.
I'll post it in chat in a moment as well.
Sure.
And
unemployment. No, unemployment for federal unemployment is income. It's not taxable for New Jersey, but unemployment does count. So you got to factor unemployment in and try to do this. Now I know that one of the issues that people have that are in transition is they go, well, I don't know when I'm going to get a job, so how am I going to estimate my income? And that's certainly a valid question. My advice is generally, listen, estimate it low, estimate assuming you're not going to get a job. Whatever income you know you're going to get, your unemployment and your dividends and interest, that kind of thing that you get consistently every year, put that in. If you come in, you get a job. So first of all, if you get a job, the worst case, that's going to be a good thing, right? The last of your worries is that you may have to pay back some subsidy. If you get a job early in the year, let's say you're deciding you're going to sign up for 2021, for example. You get a job early in the year, and it's going to put you over the income threshold. Yes, you will have to pay back the subsidy, but you only probably paid a subsidy for a couple of months, so it's probably not going to be that big of a deal. Let's say you get a job late in the year. That may not be enough income to get you over the subsidy, right? So you'd still get, might be higher than you estimated, but as long as you can stay under the threshold, you'd still get your subsidy. If you got a job in the middle of the year, potentially it could cost you. It really depends then on how much of risk you want to take and what is the price of your Cobra versus the unsubsidized and subsidized exchange, right? If Cobra is quite a bit less than the unsubsidized number, but more than the subsidized, you're taking a little bit of a risk that you get your job, you have to pay back that subsidy. If Cobra is close to the unsubsidized number, then there's really no downside because you're going to be paying the higher amount for Cobra anyway, and you're not going to really save anything. So you might as well, roll the dice and hope that it works out. So anyway, so that's my general advice is you probably, if you're not sure how to forecast, you're going to want to forecast low.
Okay, I think we can move on, Bill.
Okay, and then I'm just going to do a couple more points, and then I'll be done with this. The red section, that's an FYI. There's a second subsidy out here. It's not just a premium subsidy. That's a cost-sharing subsidy. So if your income falls below the second threshold, not only do you get a subsidy on your premium, you also get a subsidy on the cost-sharing, which means your deductibles go down, your co-pays go down, and they depend. If you're really close to the green line, all right, those subsidies are significant. Like I have said, single people with premiums of $79 or $80 a month with a deductible of $200 and out-of-pocket max of $500. They're really low numbers, okay? And that you don't have to pay back. just so you know. Now, you are going to have to justify your income to the government if you're going to come in a lot lower than what they've seen, tax returns that they have on file. But assuming that it's valid, you lost your job or whatever, if you do come in over those numbers, you're not going to have to pay that back, unlike the premium subsidy. So again, it works to estimate low. And then if you're in green below those thresholds, now you're out of the Affordable Care Act altogether, and now you're on Medicaid, or what New Jersey calls the family care, which is free, except, the issue that some people have with Medicaid is that the doctor networks are very restricted because the reimbursements for Medicaid are so low. So a lot of doctors don't want to deal with it, particularly in the more affluent areas. And so I've had a situation where clients, they want to get just over that Medicaid threshold, their income was going to come below it. And then we do something like a Roth conversion to get their income above that threshold, and then they sign up for an Affordable Care Act claim. So just for terms of when you can do this, you have again, once you lose your job, you have a 60-day window where you're able to go in and sign up. If in the middle of the year, you decided to go on Cobra, and then a few months later you change your mind, it's too late. You're going to have to wait to the next open enrollment. Now, open enrollment is coming up, right? Open enrollment for 2021 is going to be starting November 1 and going to run through December 15th. So if it's something you want to consider for 2021, that's the time to do it. And you have that 45-day window, although I think New Jersey, going on our exchange, may extend that to sign up. And then the other time you're eligible is if your Cobra ends. So when your Cobra ends, that gives you another open enrollment window. And just so you understand what they're doing is, what the insurance companies want to avoid is a situation where somebody essentially, thinks it's healthy, doesn't want to pay the health insurance premiums, and so doesn't sign up for insurance. Then they get sick. Now they want insurance, right? That's called adverse selection. It's bad for the insurance company. So there's two ways to manage that. One is underwriting, which is the historic way insurance companies done it. If you're sick, you have pre-existing conditions, you just don't get any insurance, right? That's what the way it was pre-ACA. Obviously, that was very controversial. Part of the goal of the ACA was to make sure insurance was available to everybody who wanted it. So now you can get it as long as you sign up either in open enrollment or when you have a qualified event, basically, is what allows you to get your insurance. And if you don't sign up during those periods, you have to wait until the next open enrollment. And I think then that is about it. Money from an inheritance is not income. No, inheritance money is not considered income. No. I mean, obviously, whatever you invest, if you invest the inheritance, unless it's an annuity. If you're inheriting an annuity, that may be taxable. But if you're just inheriting a regular bank account or even an IRA or anything like that, none of that's taxable. Okay, so that's it. It's a lot for one slide. Couple other things on medical. The IRS does allow once in your life to transfer money from an IRA to an HSA. And I did this actually my first year out, starting my business, as a way to fund, my medical expenses for the year. Is for those not familiar with an HSA, it's a pretty sweet deal. Essentially, you're able to put in, if you're a single person, $3,550 a year. If you're a family, $7,100, and there's $1,000 catch-up if you're over age 55 on top of that, into a health savings account. Now, a health savings account is different from a flexible spending account. Flexible spending accounts, as you may be aware, right, you have to use up the money during the year. You set it aside, but you have to use it up, and when you don't use up, you lose. HSAs are not like that. HSAs are separate accounts that you have with a bank or a brokerage firm, usually a bank, and that money basically is there. You can use it for the rest of your life, right? And you can use HSAs to reimburse yourself for Medicare premiums, so you will eventually use it up. And what's great about HSAs is that it's pre-tax money going in. So it's the same as a pre-tax IRA or a 401k at work. But unlike an IRA and 401k, if you pull it out for medical expenses, it's not taxed. So it's not tax going in, it's not tax coming out, and it's really the only investment vehicle that I'm aware of that's like that. So I even tell my financial planning clients, right, if they have access to an HSA, max that out even before, right, you max out your IRAs or even your 401k after you get past the match, because the HSA is so valuable. And again, you will eventually use it up. And worst case, if you're over age 65 and you pull it out and you don't use it for medical expenses, you just pay the tax on it like it was a regular IRA. You haven't lost anything. So HSAs are a great deal. So the IRS does allow you once in your lifetime to transfer up to that annual max from an IRA to an HSA. Now, because an IRA is pre-tax, you don't get a tax deduction. It just means now when that money comes out to pay for your medical expenses, you're not going to get taxed on it. So it's better if you have the resources to fund it using after-tax money from a savings account or whatever. But if that's not an option and your cash flow is limited, you could move the money from an IRA to an HSA and then withdraw that to pay your co-pays and your deductibles. Couple of things. So withdrawals from a 401k or IRA, if you're under 59 and a half, for those who are not familiar, with 401ks or IRAs, if you take money out before 59 and a half, you have to pay the tax, but you also have to pay a 10% penalty, right? The IRS is trying to incent people to use those for retirement, and they're saying you shouldn't be retired before 59 and a half. Somewhat arbitrary, I realize, but if you use it for medical expenses in excess of 10% of your adjusted gross income, then you don't have to pay the 10% penalty. And also withdrawals from an IRA, but not a 401k, that's the difference between the two, and you use to pay for medical insurance premiums, you're not subject to the 10% penalty if you've been collecting unemployment for at least 12 weeks. So they're basically saying we don't want to penalize somebody who's unemployed and needs to, to draw out of their IRA to help pay their medical premiums to add, make things even worse by making them pay a penalty. You do have to pay the tax, you just don't have to pay the penalty. Okay. All right. Any more questions on healthcare before we move on?
They're not posted, so let's.
Does IRA also refer to a SEP IRA? That one is a good question. I'd have to. I think so, but I have to double check. Worst case, you could roll a SEP IRA over to a regular IRA easily enough, but I'm pretty sure you can do that. I'd have to double check on that one. I don't know for 100% sure. I think the answer is yes, but I don't. We have to follow up on that one. Okay. All right. Okay, so this is just a touch base, on just some of the tax law changes that have gone in the last year or two, right? Just a reminder on this. Question: I have an HSA. My son's a dependent. Can he use the HSA? No. You can use the HSA for, if it's your HSA, you can only use it for your basically your tax dependents, right? You, your spouse, your dependent children. If your son is independent, you can't use the HSA to pay his medical expenses. He'd have to be eligible for his own HSA to be able to do that. And a SEP IRA, somebody asked, that's a SEP IRA is if you're self-employed. They basically, it allows you to put more money into a so let's assume you're a self-employed person and you don't have access to a 401k. The IRS has a plan out there called a SEP IRA that you can set up with, any brokerage firm or wherever, that allows you to put more money in than you could put into just a regular, IRA, which is limited to, 6,000 a year plus 1,000 catch up. Whereas a SEP IRA, you could put up to 20% of your income from the business up to a certain limit. So it just gives you more flexibility in terms of putting money in. Okay, but it's basically for self-employed people. Okay. So then again, yes, you do get a tax break for the contribution to SEP IRA and a solo 401k. Again, because 401k money is pre-tax when you're working. If you're not single, if you're not working, you're working for yourself. Anything you put into a SEP IRA or a solo 401k is a tax deduction, or is a reduction of your income on your tax return. It's part of that adjusted gross income calculation that I talked about. It's above the line deduction, which lowers your AGI, and then has an impact potentially on your subsidy that you might get. Okay. So some of the taxes, just a brief overview on the taxes. You may be all pretty familiar. It's been a couple of years now, but so the tax rates will remain lower, right, through 2025. They got rid of the exemptions. The standard deductions have increased quite significantly from where they used to be, and because they put a cap on state and local income taxes at 10,000, a lot more people, even most of my clients, I would say, now don't itemize any longer, right? Because if you remember when talking about deductions, you either take the higher of your standard or your itemized. But if your taxes are capped at 10, and let's say you're a married filing joint and you have a $24,400 standard, you'd have to have $14,400 of mortgage interest and/or charitable just to get to the standard. And a lot of people don't have that high, it's really the mortgage interest. You have to have a big mortgage really nowadays to get over the threshold. So vast majority of people now just take the standard deduction, which I tended to simplify things. To offset the exemptions that were limited, they've got a child tax credit of $2,000, got bumped up, and it also the income threshold to be able to claim it has gone way up, so a lot more people are able to claim that. And they also added this dependent care credit. So if you have somebody, let's say a college-age student who's no longer eligible for the child tax credit, you still get a $500 credit then, as long as they're your dependent. As I mentioned, state and local, this was a big, obviously, controversy when this law was passed, right? That in high tax states like New Jersey, the property tax, a lot of people pay $10,000 in property taxes, right? Your limited income taxes and property taxes combined, right, is limited to $10,000. They got rid of miscellaneous itemized deductions. That affects people in job transition because you used to be able, back in the day, you used to be able to deduct all of your job hunting expenses, were considered employee expenses. So, your mileage to these, now of course no mileage because everything's remote, but and when you were still driving to these meetings, resume review, expenses, if you hire a career coach, anything like that, that was all tax deductible. It is no longer. And then home equity interest is not deductible any longer unless it's used for home improvement. Used to be able to take up to $100,000, could really be used for anything. It's still deductible. Now there's no $100,000 limit, but home equity is only deductible if you use it for home improvement. So you have to track your expenses. And then they added a qualified business income deduction for basically self-employed people. Another kind of benefit for being self-employed. They gave a big tax cut to corporations. And so they said, what about the small business owner? So they added this QBI deduction, which is essentially a 20% deduction of a small business income. Unless you hit certain income thresholds pretty high, over 320,000, and then that starts to phase out. What percentage of the dollars paid for Cobra would be tax deductible? So Cobra shows up, and now Cobra cannot be considered a self-employed plan. Okay, so you can't take that above the line like you would, which is something to consider, honestly, between Cobra and if you're self-employed, anyways. Because if you have your own business, to the degree you have income, you can take the cost of your premiums as a self-employed health insurance deduction above the line, so there's no limit on it. Cobra gets deducted on the back page of it's on Schedule A. It's an itemized deduction. So there's two issues with that. Number one is that it's medical expenses on Schedule A are only deductible to the degree they exceed 10% of your adjusted gross income. So it depends on what your adjusted gross income. If it's low, then your Cobra at $2,000 a month might get you over. Then the second hurdles you got to get over is you got to get over that $24,000. So now you look at your medical expenses above 10% of your AGI, plus your $10,000 of state and local taxes, plus any mortgage interest, plus any charitable. So whether that's going to have an impact on your tax ultimately depends on whether you're going to be able to get over that $24,000 threshold. If you're single, obviously the threshold is much easier to get over, right? It's 12. Not that it's a good thing, because it's 24 is a lot more than 12, but the standard deduction for a single person is $12,200, and obviously but the $10,000 cap is still the same whether you're a single or married filing joint. So it's obviously much easier to get over the itemized threshold for single. So the answer to that question all depends on your tax situation and whether you're able to itemize to a degree that's going to have an impact on your taxes. QBI and how it works. So essentially, again, if you're self-employed, right, and so example, if you're doing consulting, you're getting a 1099. It's basically income you're not getting from a W-2, and basically you have your net income, right? So you have a Schedule C that you fill out. You have your income and you have your expenses for running your business. Then you have your net income. If your income, your overall family, income is under certain thresholds, you get a deduction of 20% of that net income that you have from your business, basically. And if you want to go into more detail, you can certainly call me and talk you through it. Okay, anything on the taxes? And then the other thing that was changed, and this was actually, early this year, right, was the Secure Act, which had some changes, right? So things to think about. One is that you used to not be able to contribute to your IRA after you were age 70 and a half. Now they're allowing you, so as long as you have earned income, now you can't contribute to an IRA if you don't have earned income, but if you're working still, for example, or self-employed or still working at age 72 or 73, right, you can contribute to an IRA now up to the degree that you've got earned income to the IRA max, which again is $6,000. Well, if you were that old, then you'd have the catch up as well, so it'd be $7,000. Okay. The other big change that they made, and this is probably the biggest one that affects most people, is that they increased the age of required minimum distributions. For those that are not aware, I talked about earlier, if you take money out of an IRA or 401k before age 59 and a half, okay, you have to pay a penalty. On the other hand, the IRS says this is retirement money for your retirement. By the time you're 70, right, or in this case 72, you should be retired. Okay, and so you're gonna have to take money out of those IRAs and 401ks. We don't care what you do with the money, right? You don't have to spend it. You could put it into a taxable brokerage account and keep it invested. We don't care what you do, but you got to take it out of the IRA and you got to pay your tax. And it's called required minimum distributions. And there's a factor that you use, right, to figure out how much that is based on your age. And so what they did is, it used to be 70 and a half. That year is the year you would have to start taking your RMD, and they bumped that up to 72. So now the year you turn 72, okay, is the year that you now have to start drawing your RMDs out of your IRAs and your 401ks. Then they had, basically, they're trying to incent more, retirement plans subject by businesses. You know, most big companies offer 401ks, but a lot of small companies didn't. So they put a lot of incentives in there to try to get, small companies. They have these multi-employer plans, which again, smaller businesses can band together to help reduce their costs of the plan administration. They get a tax credit for small business plans. So these are more on the business side to try to incent people or incent companies to offer retirement plans to their employees. They're allowed to offer annuity products, which is somewhat controversial because annuities often have high fees. I'm not necessarily a big fan of annuities necessarily, although I am in some cases, but the insurance companies obviously make a lot of money on these, and they're influential lobby, and they got this put in, and they got some disclosure requirements, and then they qualified. Oh, they do allow you a qualified distribution of 5K to support a birth or child or adoption, and then you can use some of your 529 money. You used to not only be able to pay for the actual expenses, you can now use up to $10,000 to pay for a loan repayment. And then the one big unfavorable change is they eliminated the stretch provision. So if you inherit an IRA, and the old rules, what happened was you would basically start you have to draw it out right away, but you would draw it off over your lifetime. So let's say somebody is 55 and their mom dies and they inherit an IRA. Basically, they would look at what is the lifetime table from somebody age 55, and that person would have to draw a little bit amount every year based on their mortality factor at age 55. They basically stretch it out for the rest of their life. Now, what the new rule is you have to take it out in 10 years. Doesn't matter when you take it out during that 10-year period, but it all has to come out during the 10-year period. So, so maybe something to think about if you're in that situation. You do some tax planning. So what are the upsides or downsides of rolling your 401k? Okay, so that question I'm going to get to a slide in a second here. You do need a good tax accountant. That is correct, and that's kind of why we do taxes and financial planning together, right? Because it all ties together. The new rule: if a person died last year, so it was, I believe it was, and I got to double check, but I'm fairly certain that if you died after January 1, 2020, the new rules go in effect. If they died in 2019 or prior, the old rules stay in effect. So if you're saying last year is 2019, then it's the old rules. That's correct. Okay. So a little bit of tax strategies, so things to think about, right? And what this all comes down to is the fact that if you're, where tax planning could really come into play is if you're going to be in a much different bracket, say this year than next year, or this year and some future year. If your income is going to be relatively constant year over year, there's not as much tax planning to do. And so there's two situations where a lot of these strategies come into play. One is when people retire, right? So when I've got folks that are and I have a lot of clients in their mid 60s, okay, maybe they were working corporate jobs, making high income, and now all of a sudden their income is really low, and now they're in a low income bracket because they're not collecting Social Security. They haven't hit the age where they have to draw out of their RMDs, so there's low income. But then they're going to get to 72. Now they're collecting Social Security, maybe they're getting a pension, and now they have to start drawing on their IRAs. And that oftentimes puts people into a high tax bracket. I think people are surprised, honestly, how big their income is going to be once they start having to draw down, right, on their IRAs and 401ks. So there's this opportunity in that window from whatever they say, maybe they dial back and work part-time, but whatever they're doing, and some later to understand what is the tax bracket now, right, versus what is your tax bracket going to be later, and how do you pay tax at the lower rate. So you might do things like a Roth conversion, for example. And for those that are not familiar, if you have money in a traditional IRA, you're allowed to move any amount you want out of the traditional IRA into a Roth IRA. And again, for those not familiar, with a traditional IRA, it's pre-tax. You're either getting a pre-tax, it comes out pre-tax at your work, and you're not paying tax on it. Or if it's, money into an IRA or a SEP IRA or a solo 401k, you get a tax deduction on your return. Either way, you're not paying taxes on the money when you put it in. Then when you take it out, everything that you pull out, the earnings and the principal, right, will then get taxed when you pull the money out. With a Roth IRA, it's opposite. You're putting after-tax money in, right? You've already paid taxes on it, but now that's going to grow. And then when you take money out, you're never going to pay tax on it. So it may not be intuitive, but it works out that if you're in the same tax bracket as when you put the money in as to when you take it out, you're totally indifferent, right, as to whether you do the Roth or the traditional. You're going to end up with the same amount of money after tax, whether you did a Roth or traditional. Now, where it changes and where it favors one or the other is if you're going to be in a different tax bracket now than you're going to be later or at some different time, right? Then it's going to favor one or the other. And so if you're in the low tax bracket, right, and you're going to be in a higher tax bracket later, after you're 72, then you're better off many times pulling money out of your traditional IRA, putting into a Roth, paying the tax now, and then you don't pay the tax later when you pull it out. So you pay the tax now at 12%, so you don't pay the tax later at 22. Or you pay the tax now at 24, so you don't pay later at 32, whatever brackets you're in. Now, the other situation where this comes in is obviously people in job transition, right? Because oftentimes what happens is you may end up with somebody that's in a very high tax bracket. So the year I lost my job, which is 2013, right? I had 3/4 of a year of a corporate salary. I had gotten a severance package. I had used deferred compensation, right, to save up for college, right, because the company was matching it in the early days, Best Buy. So I got paid all that out in 2013. I had an enormous income and a big tax bill, okay? Then the following year, right, I still had a decent sized income because I was able to put some of my deferred comp out. But then the following year after that, I was in a really low income bracket because now it's just me starting this business. I started with no clients. I started it from scratch. My wife's working part-time, 10 hours a week. So all of a sudden we had a low bracket. So that is often the case with folks. The years they lose their job, they're in a high bracket because of the severance and if they had deferred comp and things like that, stock options, they have to get exercised. But then if they don't get a job, they might be in a low bracket. So these strategies are for how do you take advantage of that shift in brackets. So if you're in the low bracket, so this might be the year after, right? You lose your job and now all of a sudden your income is low. You haven't got a job. Maybe you used up your unemployment and you're just living off of savings. Okay. This is when you would map out and say, okay, what is my, what do I think my tax rate's going to be later in life and versus what it is now or even next year? Do a Roth conversion and then pay that tax, right, at the lower rate. The other big opportunity, which again, we do a lot of tax planning about is if you're in the 12% tax bracket, basically the lower tax brackets, either single or married filing joint, the capital gains rate is 0. So let's just say you've been sitting on this Apple stock you bought a long time ago and you eventually want to sell it, but you're going to be looking at a big unrealized capital gain. You sell it when you're in this low bracket and your capital gains rate on that's going to be 0, up to the degree you fill up the 12% bracket, right? So it gets fairly complicated to figure out, but there's an opportunity to sell something if you got investments in a taxable account with unrealized gains, to sell it and not pay any tax on it and give a one-time shot to do that. If you're over 59.5, you want to draw money out of your IRA. I've seen situations where clients were advised to take money out of their taxable account first and leave their IRA money alone when they were in very low tax brackets. All that means the IRA is going to grow and they're going to have to pay even more tax on that later when they're required to draw it out. They would have been much better off taking the money out of the IRA to cover their expenses, right, and let the money in the taxable account alone. Now, and this gets to the slide I'm going to come in later between a difference between a 401k and an IRA, but one of the options, one of the differences is that in a 401k, if you leave the company at age 55 or over, you're allowed to draw money out without paying the 10% penalty. That's not true for an IRA. For an IRA, you got to be 59 and a half. Now, that only matters if you're actually leaving the company, right? And you got to be in the year you turn 55 or over, even if it's later in the year. So say you leave in March, but you're going to turn 55 in October, that's fine. Yeah, that still counts. So basically, just something to consider that if you're in that bracket, you may want to take money out of your 401k. You know, if you're somebody who pays estimated tax and you still itemize, which is fewer people, but it's still possible, then you pay your quarterly tax for January and December, right? I'm sorry, pay it in January rather, and then get the income tax in the year where you're gonna have the higher income deduction. And then there's credits that you might be eligible for if you're in a low bracket that you need to be aware of. Let me stop now. Let me see what the questions say.
There is one question about the bullet point about being separated from your company at 55. She's 55 now, but was under 55 when she was separated. Will she pay the 10% penalty?
No, it has to be the year she was separated. So if the year you were separated, you were 54, doesn't work. Yeah, then you can't do it. You have to have separated from the company in the year you turn 55. You could be turned 55 later in the year, but it has to be in that calendar year. Then I saw one, key on the 401k versus IM, the 59 versus 50. That's one of the variables, and I'm going to get to that. And I know everybody's curious about that. I'm going to get that in the next couple slides. And then, is it possible to pay? Oh, there was a question about the RMDs that said, yes, there was. And I apologize. You're right. I probably should have brought that up. Because of the coronavirus, you do not have to take your RMDs in 2020. So all that I was talking about RMDs doesn't apply. They'll start up in 2021 again, but as far as 2020, you don't have to take your RMDs because they had a rule because of the coronavirus, one of the aid packages. And then, is it possible to end up paying more taxes in addition than when you were working? Yeah, it is. I've seen that, particularly if you got a pension. If you layer on a pension plus Social Security plus RMDs, I have definitely seen situations where clients are making more or have higher income post 72 than they did when they were working. I mean, it's not that uncommon, in all honesty, especially now that the 32 bracket is pretty high. You got to have a pretty sizable income to get to the 32, and it's relatively easy to get to the 24 bracket. So I think that's actually more common than people would think. And was there one more here? Some exception because that allows withdrawal without penalty. You can't draw, no, as far as taking money out before 59 and a half, I got to double check on that, but I don't believe that there was an exception. You still have to pay the penalty if you pull money out of an IRA before age 59 and a half. I don't believe that was one of the things they did in this package. If you're out of work, how do you contribute to Social Security? You don't, but I mean, if you're self-employed, you start working to do self-employed stuff, then you would. So yeah, when you're out of work, you're not contributing to Social Security. But remember, Social Security is a 35-year average. So the reality is 1 or 2 years of not contributing is not going to make that much of a difference to the average. And really, most of the money that that affects your benefits come in the early days of Social Security. Meaning, let's say somebody was making $10,000 a year, right? They might collect $9,000 a year in Social Security. Somebody that goes from $100,000 to $110,000, the extra Social Security is pretty limited. It's only about 5% more, right? So in other words, most of the Social Security you're going to get from the earnings that you earned, in the lower income brackets. It is sort of progressive in that regard. So the moral of the story is I wouldn't worry about that. Your Social Security is probably not going to change very much based on any kind of job situation. Okay. And then that's it. So the next slide is going to be, what if you're in the opposite scenario? So in other words, what if you're in the high bracket this year? Like maybe this is the year that you lost your job, you got paid your severance, you got paid deferred comp, whatever it might be, And so now you're in a higher bracket than you're going to be next year. So how do you, basically what you want to do, obviously, is defer income out of this year and get expenses into this year, right, to lower your income. So if you have any ability to put money into tax deferred accounts, IRA, 401k, HSA, you want to max those out to the degree that you can. I had the option of delaying some of my deferred compensation, at least what was called the pre-Enron deferred compensation. They changed the rules because of the Enron debacle. Those guys took advantage of that back in 2005. But I had the option to defer it, so I was able to defer some of my deferred comp into the following year, which I was in a lower tax bracket. And then again, if you're itemizing, now this time you want to prepay your January mortgage payment in December so that you get the deduction in the current year. One thing, this is a strategy not even necessarily just for people in job transition, but I do this with a lot of clients, is because of that, if you are somebody who donates to charities, the issue you're going to run into oftentimes is, let's say somebody has a $10,000, I'm talking about the itemized deductions again, right? You got to get over 24.4. They know your taxes are 10,000. Let's say you've got 12,000 of mortgage interest. So now you're at 22 and you donate $2,000 a year to charity. Well, guess what? That last 2,000 of charity doesn't give you any tax benefit, because all it does is get you to 24 that you would have gotten anyways, right? So what you could do, and what clients do, is they do what's called their donor advised fund. And a donor advised fund is essentially a charity that exists to give money to other charities. So if you know for sure, right, you're going to give $2,000 a year, let's say over the next 10 years, and you have the cash available to do this, right? You basically put $20,000 into the donor advised fund. That's a donation to a charity. Now, you can't get that money back, right? But you now direct where that money goes, and it doesn't all have to go out in that year. So, for example, what you would do is you would put $20,000 in, you take a tax deduction for 20. Now, the first 2 doesn't get you anything, but the next 18 does, because now you're over 24,000. That's going to lower your income, okay? Now, what happens over the next 10 years, it's like bill pay. You log in and you say, okay, take $500 and send it to the United Way or wherever you want the money to go, and any qualified charity will show up on their list of options, and you basically got the rest of your life essentially to donate that money. So this is kind of one of the tax planning that we do fairly often now with my clients, given the change in the tax rules and losing that because of the increase in standard deduction. But something you may want to consider if you're in that high bracket year. Obviously, if you're paying estimated taxes, maybe you're self-employed, pay your taxes in December. Again, assuming that you're able to itemize, and then you can get a deduction for that. And then what the IRS allows is, if you have investments that are at a loss, you can at a capital loss, they allow up to $3,000 a loss. So let's say you just had some. You bought some stock and it's declined and now it's underwater from when you bought it. And obviously there was an opportunity at the beginning of this year. I did a lot of that with my clients, where when the market dropped 34%, right, a lot of stuff was you're trading at a current loss. It's called tax loss harvesting, right? So what you're doing is you're selling something at a loss. Even if you want to still be in that investment, you just buy something similar. Now, you can't do that with an exact stock. It's called a wash sale. But let's say somebody owns the S&P 500 index fund. They sell it. Right, they take a loss, okay? They turn around and immediately buy maybe Vanguard's large cap index fund. It's not exactly the same as the S&P. It's close, but it's not the same. And therefore, you now have a realized loss you can take in the current year to offset your income in the current year. Now, you're going to own the new one at a lower basis, so you're going to have an offsetting gain sometime in the future. But you're going to probably pay that at a lower tax rate because you're going to pay the capital gains rate, which is lower. And then B, if you hold on to it forever, or if you donate it, you don't pay any tax. Which is another thing that we do with the donor advised fund strategy. If we've got clients who have essentially gains on some stock they've been sitting on forever, and instead of donating cash, you donate the stock. You get a deduction for the value on the day you donate the stock, and you just avoided all the capital gains that are built up. So it's better if you have that option, you're going to do something like that. And you don't necessarily have to do a donor advised fund. If you're doing any charitable contribution and you have stock that's got a big unrealized gain, donate the stock instead of cash, and then you avoid the capital gain on that. Question, everyone. Okay. All right. Okay. Any more questions on all of these kind of strategies here?
Well, let's move on. We'll address them when they
Yeah.
come.
All right. So then came up a couple of times, right? Should I roll over my 401k to an IRA? Okay. So really, there's two advantages to keeping money in the 401k. One is you can borrow against a 401k. You cannot borrow against an IRA. So, and just so you know, you can borrow up to 50% of your balance, up to 50,000, right? Is what you can borrow. So now, of course, if you've left the company, right, they're not going to allow you to borrow against your old company's 401k. Very few companies are going to want to deal with the headache of that. They probably won't allow it. So in that case, what you would do is you would roll, if you think you're going to want to borrow money potentially in the near future, then what you're going to want to do is roll your 401k into your new company 401k, okay? Because then once it's in a new company 401k, then you can take a loan on it if you wanted to, okay? So that's one advantage. The second advantage, which I briefly touched on earlier, is that there's no 10% penalty if you terminate employee after age 55. So again, and somebody asked this question, if you're between 55 and 59 and a half, I generally advise my clients to leave the money sit in the 401k. I don't roll it. And I've had situations where, a client, was working with an advisor, get paid as assets under management and wanted those assets, so they convinced them to roll it, and then they needed money, and now they have to pay a penalty, right? Whereas they would have had to pay the penalty if they just left it in the 401k. So those are really the two advantages. There is some better liability protection in the 401k, but I don't necessarily consider it an advantage. I mean, somebody's we're concerned about that. I think you're better off just buying, an umbrella liability policy. It's probably going to give you better protection than leaving the money in a 401k, potentially, assuming that one of these other advantages works for you. So now here's the advantages of rolling it over. Now, the first one's probably not going to apply to most of the folks here, but you get no 10% penalty if you're a first-time home buyer in an IRA. The second one, actually, I'm doing the second one right now, in fact, is there's no 10% penalty for withdrawals for higher education expenses. So if you've got a kid in college, you can draw from your IRA. Now, you got to be careful, because if you qualify for financial aid, okay, that is income. That's going to show, because that could potentially affect your financial aid. So what I did with my sons is, I did this, but I only did this once I started doing this for my son's junior year in college, because at that point I was using, so example, my son's a junior right now, right? And so the tax year that we're going to use to fill out the FAFSA for his senior year is going to be 2019, right? Which I can start filling that out as soon as October 1st, in fact, okay? So starting in 2020, I can pay expenses and take money out of the IRA and not have to worry about the impact on financial aid, because of the fact that they don't look at they're never going to look at 2020 again. His senior year was based on 2019 income, because the FAFSA is basically 2 years prior. Okay. The other advantage, which I mentioned earlier, is that with an IRA but not a 401k, you can use the withdrawals to pay for your medical insurance if you've been collecting unemployment and not have to pay the penalty. You have much broader investment options with an IRA. You can invest in anything. Now, if you're going to take money out of a 401k, right, and give it to an advisor who's going to charge you 1%, and then and you're putting high fee funds on top of that, well, then you're probably better off leaving it in the 401k, in all honesty, right? But if you're going to put it in, you're going to buy Vanguard index funds with low fees, and I'll talk about the fees a little bit later, then in general, you're going to have better options, right, in an IRA. Because 401ks are limited to whatever funds their investment advisor had opted for. And they're usually limited to, maybe 10, 12 funds. They're getting better. Remember, there was an incentive for companies to have, because the plan sponsors make money from the fund companies that have the higher fees, they get kickbacks, basically. They were able to offer companies essentially no charge for administration fees, okay, as long as there was, money coming in from the fund companies. So essentially, the companies were benefiting at the expense of the employees. Employees having to pay higher fees, but the companies are supposed to be fiduciaries, doing what's in the best interest of the company, all right, the trustees. And so there's been some lawsuits. So now you're seeing more and more 401ks have better low fee fund options. Most of them will at least have the S&P 500, but I still see some really bad ones, right? Especially smaller companies that just don't get it, and they just don't want to spend the money, where, the fund options in a 401k are pretty rotten. And then, as I talked about earlier, a big tool in the arsenal for tax planning is Roth Conversions. And you can only do that if you've got money into an IRA. So then you roll the money from the 401k to the IRA, and then you can do it. And the other thing is, some companies won't allow it, but if they allow you to do a partial rollover, you can always do both, right? Move some money into the new 401k and move some money into the IRA. Let's see here. Under CARES Act, opposed to 401k loans can be up to 100. Oh yeah, that may be true. Yeah, I guess I probably should, now that I think about it, right? This is a miss on my part. I gotta have to make a note here that I update the CARES Act. I should probably put a slide in for the CARES Act nuances. Although of course I think it only affects this year, and then for my presentations next year, they won't matter. But yeah, I do think they did a one-time change. You could take up to 100,000, and that's correct in the 401k loan. I'm assuming it's going to go back to 50. I got to double check on that. When investing in IRAs, you can still be taxed today if you invest too much in master limited partnerships. Yeah, that's, now you're getting to a really, really technical thing. That's something you probably have to catch me offline and talk through. Yeah, I think that's having to do with whether that's considered a really valid investment in an IRA. So you got to be careful with something like that. But that's basically self-directed IRA type issues, probably beyond the scope of what we're talking about here. Okay. All right. Then there's some comments on debt, right? So if you got to take on some debt for whatever reason, if the issues are, money is really tight, right? Obviously lower your tap your lower rate source credit first, home equity loans, cash. If you got a life insurance policy with cash value, you can borrow against that. Usually you can go to a bank. In fact, you don't have to borrow from the insurance company. A lot of banks will issue loans against cash value, just like a home equity. And so you might want to look at that. Those are going to be lower rates, 4-5% versus certainly credit card at a much higher rates, right? Understand if you have to use credit cards, just understand, what the rates you're paying. Cash advances often have higher rates, right, than purchases. You want to look at your credit reports annually just to make sure that's not affecting your ability to get good rates on debt. The credit reports have to allow you to access once a year, although not to the score. Although most credit card companies will give you, as a Benny, access to your credit score. And there's two of them out there, right? There's FICO, which is the main one. That's hard to get your hands on because that's still the one that most banks use. There's also another one called Vantage Score that the credit agencies came up with to try to not pay, so that FICO, which is Fair Isaac, did have a corner on the market, and they pay a lot of money for that. But either way, you want to kind of get a sense for, is there anything, we had an issue with my wife where some doctor thing got screwed up, a few years ago, and then we went to get a refinance. It became a big mess because of that. If you're close to your credit limits, that's going to have a negative impact on your score. You want to keep your, revolving lines under 30% of your limit. Obviously, you want to pay more than your minimum due, and certainly don't miss a payment, right? Missed payments can have a real negative impact on your score. Okay. Yeah, and then you can also borrow against your brokerage accounts. That's correct. Yep. And the rates, I've seen the rates all over the place. I know some good, some really bad. So you got to be careful what the rate is. These are some questions that came up over time on unemployment. Can I get more than my 26? And this, well, obviously this all changed. It probably should have had the update for the CARES Act here, well, right, with the extra $600, although that's since gone. But and there's, in normal times, right, you can extend unemployment beyond the 26 weeks if you're get enrolled in an approved training program. Now you got to work with the folks at unemployment. You can't just say, hey, my brother-in-law is going to teach me Excel or something. That won't work. And there's also grants available, and the grant money can dry up, although you may want to look at other counties. Usually the money is allocated by county. So if your county's out of money, you can check other counties, right, to see if they have it. But so there's something to consider as a way to get extended unemployment. And then the other questions come up is what happens if you work part-time, right, kind of survival wages, and essentially they give you sort of a 20% push before it starts to impact, or 20% before it increase before it starts to impact your benefit. And then beyond that, essentially reduces your benefit on a weekly basis, but doesn't reduce the overall amount you're going to get. In other words, unemployment is calculated essentially as a lump sum that says, based on the calculation of your average earnings and everything else, here is the amount that you're eligible for, spread out over 26 weeks. If you start earning some part-time income beyond the threshold, that starts to reduce that. all that happens is those unemployment benefits get extended out, right, until you ultimately collect it, right? That same lump sum, basically. And obviously, if you get to a point where you're earning more money, where your unemployment gets to zero, well, then in the eyes of the state, you're employed, right? But you still got to be active. If you are still going to try to collect, still got to be actively searching for work and meet all the other requirements. The other thing to be aware of is 401k withdrawal. This is also another thing about a 401k versus IRA. In New Jersey, the 401k withdrawals may impact your benefit, right? Because of the fact that a portion may have been contributed by the employer, and New Jersey factors that in. So if you're in that situation, right, you may want to do a rollover to an IRA first before you withdraw from the 401k if it's going to have an impact on your unemployment. All right. College, just a real quick slide here. I mean, obviously, some colleges are going to be more willing to work with you if your circumstances have changed than others, but you're certainly not going to hurt to ask, right? So you want to reach out to the financial aid office if all of a sudden, the income has dropped significantly, and see if there's anything they're going to be able to do. Private schools tend to have more flexibility than public schools in that regard, but it certainly isn't going to hurt to ask. Just as a general financial aid, if anybody's got kids that are either thinking about college, look at a lot of financial aid given out these days as merit-based, right, as opposed to need-based aid. And so, be aware, and it could be for any number of things. It could be athletics, it could be academics, it's probably the most common one. Could be like, the students, a violin impresario, and the orchestra needs a violin player, whatever it might be. Could be geography. We used to live in Minnesota, and so we were familiar. The schools in Minnesota are not big on the radar from New Jersey. So we looked at schools like St. Olaf College and in Minnesota, got a really good merit aid package for my son because they're trying to attract students from New Jersey. Let's see. Okay, I'll come back to that in a second. And then merit aid, and then you could also draw money, as I talked about earlier, out of the IRA without 10% penalties for qualified higher education. And we got a question here. I thought an IRA withdrawal impacted unemployment. My understanding, it does not. Is anybody more? I mean, my understanding, it's not. Does anybody know that to be different? But my understanding, IRA withdrawals are not impact. Do not impact unemployment. It's all based on your earnings that you earned from your employer, and because a portion of 401k is considered employer, that's considered employer earnings. If you're originating, haven't they granted an extension due to COVID? Yeah, and that's, again, there may be some specific rules because of COVID that I probably should have factored in that I didn't. Let's see, my next question was federal unemployment. New Jersey's not paying the $300. That I'm not sure on. I don't know if anybody knows the answer to that question. Obviously after, the $600 ran out, Congress could not come to an agreement. So Trump went out and said, I'm going to do, the federal government's going to pay 75%, states got to kick in 25%. I know Florida, for example, just said we can't do it. We want to do it, but we don't have the money. I don't know if Jersey's going to go back and try to repay that. I don't know the answer to that question. You have to look that up. Can you avoid a penalty? Am I paying for student loans? Student loans, no. It has to be student qualified student expenses to avoid the penalty, not student loans. Nice here, St. Olaf. Oh yeah, St. Olaf. I love that school. My son opted not to go there. It was a second choice, but it was certainly a good option for us. You personally funded your IRA. Yeah, you could draw the money without losing unemployment. But that was my understanding. Yeah. Okay. Because again, it's all the unemployment is all based on the earnings that your amount is based on what you earned when you were working, essentially. And the issue with the 401k is, again, because the employer contributed, if there was a company match, a portion of that may be considered employer income. That's why it affects that and not the IRA. All right. There's a little more rant on investment fees. Oh, that's maybe I got another question on that. We're in New Jersey proof for 5 weeks. System will be updated. Yeah, probably. Yeah, and I apologize for not getting more up to speed on exactly what the unemployment nuances are on this one. I'm not sure exactly how this. I was just looking at more kind of normal times, and I didn't prep for the specifics of what's going on with Cobra. My bad on that. As far as investment fees, so basically this is a rant on, say, hey, 1% doesn't seem like a lot, but 1% really adds up over time. This is just an example of a $250,000 portfolio. You pay 1% over 30 years, your ending portfolio, earning, say you earn 5% of the portfolio. I'm sorry. Well, actually, you're earning a 7%, right, on the portfolio. The impact would be, $600,000, right, over your ending portfolio, which is quite a bit of money, obviously, and some people have obviously portfolios significantly larger than 250,000. That 1% fee adds up, and it's a real drag, on the earnings. The problem with it is the issue is whether you believe that somebody actively managing the portfolio is able to do better than the market. We are the belief that that's nearly impossible to do. A study that Vanguard did basically said that, because by definition, okay, let's say you've got a fund manager who's managing money, and they're trying to decide, let's say it's a large cap fund. So they're trying to, of the 500 S&P large cap stocks, maybe we want to own 80 or 90 stocks. We're trying to decide which one. So let's say they've done all their research for the day, and they decided, you know what, now's the time to buy Apple stock. The issue is some other really smart fund manager did all the research and decided today's the day to sell Apple stock, right? And so the problem is one of those persons is right and one's wrong. So by definition, these people, right, that are managing funds, by definition, 50% are going to do better than the market over the course of the year, and 50% are going to do worse because the market is the average of all these participants, okay? Before fees, they're now charging you a fee to do that work, right? Could be 1%, could be 0.8%, 0.7%, whatever that is. The number that beat the fees in any given year, now it drops down to 30. That beat the market enough to justify the fee. And over 15 years, that number drops to like 18%. So if you knew after the fact, it's easy to see who were the 18% that did better than the market. But the problem is it's very hard to know at the beginning who are going to be the 18%. So the philosophy we believe in is forget all of that, right? Just own index funds, which means with an index fund, you own the entire market. If it's large cap, you own all 500 S&P, right? And you don't try to decide whether Apple's going to do better than General Motors is going to do better than IBM. You own them all. And because the market has gone up over time, and you just go with the market and you don't try to beat it, basically. And there the fees are 0.03%, 0.04%, much lower. Save the fees and just go with the market. It's basically the idea. 10 months payment expired. For extra 20 weeks. Okay. Yeah, so you guys will have to follow up, yeah, on the and Dave maybe something on the how it's going to work in New Jersey on unemployment. Okay, and then the last rant that I have is on Social Security. So a lot of people opt for, when should I take Social Security? But basically, our philosophy for most of my clients that I work with, right, the answer is usually is wait to age 70, wait for as long as possible, which is honestly the opposite of what most people do, right? So I'd say about half the country files at 62, the earliest possible age, with most of the rest filing near their full retirement age, which right now is 66, but it's going to be going up to 67. And the reason that in most cases I think it's best to wait is that Social Security grows about 8% a year, every year for the rest of your life. And particularly if you're a couple, you almost certainly want to have the higher earning spouse wait, because then that higher amount is what the surviving spouse is going to earn on it, right? And people say, well, what's the break even? And the break even is usually around, I don't know, age 78 or something like that, 79. But I don't think break even is the right way to think about it. When you're worried about retirement, what you're really thinking about is making sure you're not going to run out of retirement during your lifetime. That's the objective, right? So let's look at these scenarios here, right? Let's say, for example, right, you file at 62. I'm going to use the earliest possible time and the latest possible time as illustration, right? And then you get hit by a bus at 72, right? It is true you did not get as much money. I mean, you would have been better off, right, if you knew that you were going to live to 72 to take it at 62, and vice versa. If you knew you were going to live to 95, these are the green boxes, you'd be better if you filed at 70. But you don't know, right? So let's take the yellow box. You file at 70, and then you get hit by a bus at 72. You obviously collected less in Social Security than you would have collected had you filed at 62, okay? But in theory, that should not have destroyed your financial plan. Now, it's obviously a bad thing to get hit by a bus at 72, But from a financial standpoint, if you plan for your retirement, you should not have run out of money at age 72, okay? The red box is the issue, right? What if you file at 62 and now you live to 95? This red box really defines the retirement crisis in the United States, right? You've got a lot of people out there who filed as early as they could, making maybe $20,000 a year per spouse, and then one of the spouses dies, and now they're left with a 20, somebody's trying to live on a widow or a widower trying to live on $20,000 a year, right? That's the real issue, right? Whereas if you have two higher earning spouses, waiting to 70, Social Security is going to be about $80,000 a year in today's dollars, right? That's a pretty comfortable retirement just on Social Security alone. So for most clients, right, it's generally going to make sense to wait to 70. Now, if a spouse earns less than half of their spouse, then it oftentimes makes sense to do it at full retirement. But the gist of it is waiting later for most people. Now, if you have no resources and you absolutely have to, live off Social Security, that so be it, right? But if you've got the resources sitting in a portfolio, you're better off. I'm not saying you got to work till 70, right? I'm saying you can retire at 64 or whatever, and then live off the portfolio from 64 to 70 and let Social Security grow, and that's safer in the long run. Although intuitively people think it's safer to, leave the portfolio, draw for Social Security. It's actually safer in most cases to do the opposite. Live off the portfolio, let Social Security grow. So kind of my rant on that. Social Security slide is great. Qualified extensions. What about firms that claim to put investors first? Well, everybody is going to claim to put investors first, right? It all depends on what their fees are, and are they really going to be able to deliver the value? My philosophy is, and some are going to do better and some are going to do worse in the market, but it's really, really tough to do, especially if you're paying high fees, right, to do that over a long period of time. What is the best order of accounts to draw down? I got to be honest with you, that's essentially what my clients pay me to figure out, right? We do a 20-year tax forecast for everybody, so we understand what the tax rate's going to be every year. And then as they need money, we're trying to decide. And there's a lot of variables, right? So in New Jersey, for example, you got to consider the fact that if your income goes over 100,000, right? If you keep your income 100,000, you pay no income tax in New Jersey, right? So in some cases, we're trying to make sure we go up to the point where, we keep New Jersey income at 100,000, right? In some cases, there's no way they can keep it at 100,000. And so now we're looking at, do we want to take it out of the taxable account? Is there something they want to sell? What's the capital gain impact? Or do we take it out of the IRA? So that's a very complex discussion. It all depends on the actual situation of your particular situation, right? And again, that's where we spend, obviously, as you can tell, less time on the portfolio because we basically build pretty basic, standard portfolios. And this is where we spend all our time is figuring out questions like that. So that's not something I can just necessarily answer. It all depends on your situation. Yeah. Then the next thing I had, well, actually, maybe before I get into this, any other questions on the presentation before I move on to the next thing? Okay. Career and transition, that's no money being deducted. So how does that impact the amount received? Yes, I talked about it earlier. So Social Security is a 35-year average. And so really 1 or 2 years isn't going to make much of a difference, in all honesty. So I would not worry about the impact on Social Security. It's going to be, and because it's progressive, the reality is anybody making more than 100,000 a year is going to get about the same in Social Security. Anywhere from 100,000 to $2 million a year, because as you guys are all aware, you only pay into Social Security up to 134,000 and maybe 137,000. I forget what the exact number is right now, right? And then they stop collecting. So somebody making 137,000 basically pays in and gets the same Social Security as somebody making $1 million a year. Okay. Now that's one of the things they may change, right? I would think at some point to help fund Social Security in the future is going to be, raising that limit. But it's not the way it is today. If you plan to take Social Security at 70 and you die prior to that, well, then it's going to be at whatever date you die. So let's say you die at age 69, then they'll calculate the benefit as you had collected on the date of your death, and that's what your spouse gets. Yeah. So it'd be more than obviously if you filed earlier, but not as much as if you lived till 70. Or waiting to 70, take years at a higher rate. And they used to have all kinds of fancy strategies, right? File and suspend. A lot of that got eliminated unless you're at a certain age. You might get grandfathered in, probably again beyond the scope of today. But there are, you got to look at both spouses. For clients who are old enough, right, at Social Security age now, basically, there is the option what they call file and suspend. There's also separate rules for divorced spouses. There's a lot of nuances in Social Security, but you kind of work through it. But just kind of in general, you want to make sure you think about the long-term impact of this is the point. Okay. And then the next thing I was just going to say is, if anybody is looking for a career change, again, I started this business back in 2014, started from scratch with no clients and started going to these job networking groups, meeting with people, and built it up. Now I've kind of tapped out myself, about 2 years ago. I've got a partner, I'll have information on the next slide, joined me about 3 years ago. He's getting kind of tapped out. We got somebody joining us in November, but if there's anybody else that's interested doing something like this, it's turned out to be a great thing for me. Obviously, no more corporate meetings, no more influencing without authority, no more, endless meetings, no more performance reviews, all of that stuff, no more politics. And so I really like the work. We feel like we add a lot of value to our clients. They really appreciate it's all one-on-one, and I control my destiny, right? You have as many clients as you want. It's not a salary job that we're looking for. It's basically somebody who wants to run their own business, and they would just do it under our umbrella. But if something might be interested, you just want to talk about it, feel free to reach out. And the way to do that will be, here's my contact information. So, and also we send the blog out. So if anybody just wants to get added to I usually, I'm at the live meetings, I pass around a sign-up sheet. I haven't been really good at keeping up on the blog in all honesty in recent months, but I will definitely get back to it. And so, I'm not going to sell your name or do anything, but if you're interested in getting our monthly blog, which hopefully be monthly soon, before too long, just shoot me an email with your email information, name and email, and I'll throw you on the blog distribution list. Or if you got any questions about anything that we talked about, here's my contact information. Feel free to reach out. If Social Security caps at one average of 30 years means, okay, so what the 30-year average is they take your inflation adjusted average over the last 35 years of earnings. So if you earned 135 this year, and then you earned, 132 last year, and then going all the way back 35 years, they take an average, but it is inflation adjusted. So it's not as if, when you started out making 40 grand, right, that is what the number is, right? It's going to be 40 grand adjusted for inflation since then, right, over the last 35 years. So basically they take an average, inflation adjusted average of 35 years to determine what your benefit's going to be. And I'll definitely get David the slide. So I should have gotten to him earlier, but as soon as we're done here, I'll shoot this over to him and he'll post it and you can get the slides. And anything else? Okay, I'll turn out the screen then, I guess, right, David? So we can do the
yeah, if you want to leave this up another moment or two, that's fine, because I'm going to close out the meeting. So this way people can take a screenshot. I did post it also in the chat. I posted your contact, not Jim's. So we will be making the chat available for downloaders later as well, but there's Bill's contact information. Bill, I'm always so pleased that you're able to participate and be a part of our group each year. I always find this to be the most informative program that we set each year, or certainly among the most informative. While it's not quote unquote core job search, these are all things that impact people in, and then of course after your job search is over, making your financial decisions. And the types of decisions that we make for our finances become more involved as we get closer to and through retirement. When we were younger, we were happy just to have an income and save some money. And so for those people that have more responsibilities, financial needs, it just becomes incredibly important to pay attention to these types of topics. So Bill, thank you so much.
Sure. All right. I'll turn off my screen here.
Okay, good. And so we do have some programs coming up over the next 2 weeks. Well, we have through, I guess, the end of the year. Our event calendar is populated into October, maybe November by now. So of course you can look at psgofmercercounty.org and look at our event calendar to see what's coming up. But for the next 2 weeks, next week, career consultant Erin Haywood will be joining us. How to build a compelling online presence. That becomes incredibly relevant. You are hoping that maybe people can find you, or now that you've sent your resume in and they begin to search for you via Google that you have a very compelling presence. They really want to talk to you. So having an online presence can be really a differentiator between you and the competition. So that's next week, September 25th, Aaron Haywood will be here. Then the following week will be October already. Stan Silverman will be here. He is a leadership coach. Stan will be here to talk about, when searching for a job, how to create a competitive advantage for yourself. Stan, in his prior career, was a senior manager in several organizations, and he's now parlayed that into becoming a leadership coach. So that's what's coming up for the next 2 weeks. There are certainly lots of other programs that are available and meetings that are available. Tomorrow morning, if you're available tomorrow morning, the Career Support Group will be presenting John Hadley, interviewing during the COVID era. So if you want more information, it's tomorrow morning, 8:30 in the morning, and go to careersupportgroup.org, careersupportgroup.org. That is a virtual meeting. PSG of Central Jersey, they will be meeting on Mondays. That they've been doing this virtually as well, Mondays at 10:30 in the morning, and they are doing a speed interviewing workshop this week coming up, so that may be of interest to some of you. And PSG of Morris County, they meet each Wednesday morning at 9 a.m. and you can go to psgmc.org and you can get information on connecting as well, or hang out after the meeting. If John or Carol is still on, they'll give you that information as well. And the oldest continuously running job seeker support group in New Jersey Job Seekers. They meet each Tuesday evening at 7:30 in the evening, and you can find the GoToMeeting connection info. It is in our group's LinkedIn group. I just posted that there, so you'll go get the virtual meeting connection. And what's nice about that group, it's you get to talk about what you want to talk about. There's no set agenda other than each of the participants, they create the topic of the day. So that is our program for today. I want to thank Bill once again for participating and continuing to being a supporter. For those of you that'll be celebrating the Jewish holidays coming up, Shana Tova, have a happy, healthy, and sweet new year. Rosh Hashanah starts tonight. That's the start of the Jewish Holy Week. But if we don't see you sooner, we hope that we will see you virtually next week. So bye, everybody.